Hello, it's Lee again, and this is part 3 of my video series, Advanced Topics in Credit Spreads. If you haven't seen parts 1 and 2, you should really start there. There's a link down in the description. Anyway, we covered the basics, but now we're going to take a closer look at the pitfalls, and we're going to look at how to find winning credit spreads and iron condors. Most importantly, we're going to look at what the characteristics are that make one credit spread better than another. And those are mostly centered around risk and reward or profit and loss ratio. Let's take a look. If you recall in the last video, we took a look at this chart. On this stock, I was bullish, so I decided to do a bull put spread. We also talked about how to do the bear call spread, but we're going to skip that for now and just focus on the bull put spread and take a closer look at that. In this example from the last video, we had a 80% probability of profit. That's because we sold the $80 put and we bought the $78 put for a $2 spread. So let's take a closer look at the numbers on that. So in this case, again, we're selling an $80 put, and let's say we collected 85 cents. That means that we collected an 85-cent premium to sell that put option. Now, we also bought a put, a $78 strike price put, and let's say that we paid a premium of 35 cents to buy that. That means that we had a 50 cent difference. We sold it for 85 cents and we bought it for 35 cents. So we collected a total credit of 50 cents per share, or $50 per contract. So that means that our max profit on this credit spread is $50. And of course, our max loss is 100 times the spread minus the credit. So in this case, our spread was $2. That's 80 minus 78 is $2. So it was a $200 max loss minus the $50 credit that we received. So it's really a $150 max loss on this credit spread. Okay, this one looks pretty good because we have a 33% profit ratio and a 20% loss ratio. That means that when we win, we earn 33% on our money, but when we lose, we only lose 20% of the time. So that's pretty good. But in reality, we actually win better than 80% of the time. And the reason is the difference between IV versus actual volatility. You see, implied volatility is based on market sentiment, and it's almost always greater than the actual volatility. And because of that, option prices are often inflated. So when we sell a credit spread based on implied volatility, it has deltas that are based on that math, and it usually works out in our favor as somebody that's selling the spread instead of somebody else buying the spread. Yeah, I know that was clear as mud, so I'm going to say it one more time. Implied volatility is almost always greater than actual volatility, and therefore the option prices are almost always inflated in the favor of the person selling the option instead of the person buying the option. So when you sell credit spreads, you benefit from inflated implied volatility, which makes your probability of profit usually a little bit greater than your calculated probability of profit. So far I've only showed you really good credit spreads, but the fact is it's kind of tough to find a really good credit spread. We're going to look at this one again, but instead of those great optimistic numbers that we would get for our premiums, let's look at some more realistic numbers. For instance, if we sold the $80 put, maybe we collect 32 cents. And when we sell the $78 put, maybe we only collect 26 cents. In that case, we only receive 6 cents per share, which is a $6 credit. And if you have a $6 credit on a $2 spread, your max loss is $194. So when you look at this, you only have a 3% profit ratio and a 20% loss ratio. So this isn't looking very good. We want high probability of profit, but we also care just as much, if not more, about your profit and loss ratios. These numbers are really all based on our models and our distribution curve. So we want a high probability of profit, something like 99%, but that's hard because the premiums are really low. I mean, think about it. If your pop is 99%, that means that your option only has a 1% chance of expiring in the money. So that might be perfect for you as the seller, but it's not so great for the buyer. They're not going to want to pay very much for it if it only has a 1% chance of working out. So even if you can find somebody, they're just not paying a lot. So you need to sell an option that has a decent chance of expiring in the money so that you can collect a nice premium. but not too good of a chance because you still want to have a high probability trade. I found that the sweet spot is usually under 1 standard deviation. Usually that's a 20 delta or something like that. It has a pretty good balance of risk and reward, but anywhere from 15 to 45 delta range could be good. Anyway, that's my personal opinion. You might find something a little bit different yourself. Another big consideration for winning credit spreads is liquidity. Highly liquid options are going to be much easier to trade. You want to be able to get in and out of the trade quickly and easily without a lot of price slippage. So how do we measure liquidity? First, there's high volume. There's high volume in the underlying stock, but there's also high volume in the option itself. Now, volume is the number of contracts sold on a given day. So if it's Friday morning at 9:31 a.m., you might only have a volume of 1, but on Friday afternoon, it might be 1,000. And on Saturday, it will be 0 all day because the volume is the number of contracts sold that day. We could also look at a thing called open interest. Open interest is the number of outstanding contracts. So that will tell you how many contracts exist already in the marketplace. If there's not a lot of open contracts, then that means that there's not a lot of interest in this particular option. Now, you might find that something like the $41 strike has really high open interest, but the $41.50 strike has really low open interest because those 50-cent increments don't really have as much volume or as much open interest as the $1 increments. And you might find that the $5 increments are even higher open interest. You'll also find that the weekly contracts have lower open interest and volume than the monthly contracts or the quarterly contracts. So it's something to consider, but it really just boils down to having a tight bid-ask spread. And what we want to see is that the difference between the bid and the ask is as small as possible, maybe 1 cent or 2 cents. Sometimes I look at things that are up to 10 cents, but if there's a 25 cent or a $1 bid-ask spread, there's no way I'm going anywhere near those because you just simply have too much slippage. You get in and you get out and you've lost $1 already, and it doesn't even matter what the volatility did. It doesn't matter what the theta did. It doesn't matter what the underlying price change was. If the bid-ask spread is too wide, you're going to end up losing money on that trade. Another characteristic of winning credit spreads is high implied volatility. High IV inflates the option premiums. So when you're selling, this really works in your benefit. You want to sell a spread with high IV. But we like to say that IV is mean reverting. That means that normally when it's high, it'll drop back down to its average. So you want to open your credit spreads with high IV and then close your positions later when IV is lower. So if we go back to the chart, we can see that the price is jumping all around. There were a few price gaps. There's some big green bars. There's a few big red bars. And with all this price action, we know that we're going to have high IV. We want high IV, but we don't want too high of IV. We'll look at this other chart, for example. You can see that it was ranging for a while, but now it's gone parabolic. I have no idea where the price action's going. So we want the high IV for the inflated premiums, but we don't want crazy high IV because then we have unpredictable moves. Anyway, we measure relative IV with 2 indicators. We have IV rank and IV percentile. Both show you how the current implied volatility measures up to the normal IV for the stock. For instance, IV percentile tells you the percentage of days that the IV was below the current IV. So an IV percentile of 50% means that half the days in the last year were lower IV. An IV percentile of 100% means that today is the highest IV for the entire trailing year. So that's probably a little bit too risky. And an IV of 75 means that the IV is higher than normal, but not too crazy. So that might be a great selling opportunity for you. Another way we can increase our profits or increase our profit and loss ratios with credit spreads is to do an iron condor instead of just a straight vertical spread. So let's take a look. On this one, we know the stock price was $88.92. And if we look at the bear call spread, we sell the strike price, the $100 call option, and collect $1 premium. And then we buy the 102 call option and pay a 50-cent premium. So it's a 50-cent credit that you get, and you have a max profit of $50. And that means that in this case, our max loss is $150. It's our spread times 100 minus our max profit. It's $150. And you could also consider the bull put spread. And in that case, you would sell the $80 put and collect $1, and you would buy the $78 put and pay 50 cents. And in this case, again, you have a max profit of $50 and a max loss of $150. But if you do both of them at the same time, your max loss remains at $150, but your max profit is the combined total of the two. It's $100 instead of $50 each. So now instead of having a $50 max reward with a max loss of $150, you have a $100 max reward with a max loss of $150. And what's important to realize here is that you can't lose on both sides. You can stay in the middle and make your max profit. The price could go up and you can have a max loss on your high end, or the price can go way down and you can have a max loss on your low end, but you can't lose on both sides. You can only lose on one side or the other. So even though each of the verticals individually has $150 risk, the iron condor as a whole still only has $150 risk. So you're able to double your profits and not double your risk. So an iron condor can sometimes be far superior to just a vertical spread. But the catch is you have to have a neutral outlook on the stock, or else it doesn't make sense. Okay, so now that you know what you're looking for, you can go out and start looking for vertical spreads and credit spreads and iron condors that all have the characteristics that you're looking for, which is a high probability of profit, a high probability trade, and a nice risk-reward ratio. But the problem that you're going to find is that it's difficult to find credit spreads that are really profitable and meet all of your criteria. So that's why we use scanners. The first scanner that I found was the thinkorswim credit scanner. It's built into thinkorswim, and it does an okay job, but it doesn't do iron condors, and it's just not great. But you should probably take a look at it and see how to use it. There's a few other web pages out there like Market Chameleon and barchart.com that have credit spread scanners built into them, but these charge monthly fees. I think Market Chameleon is like $50. I'm not sure. And it's pretty good, but it still doesn't have all the features that I want. And barchart.com doesn't even do iron condors. It only does vertical spreads. So I'm not really impressed with it, not for the money. So what I did was I came up with my own custom scanner. It's actually a piece of software that I wrote that ties into the TD Ameritrade API. If you have a TD Ameritrade account, they give you free access to tie into their API, so you can run your own software that can do a credit spread scanner or any other kind of scanner that you want. Actually, anything that you can do in thinkorswim, you could actually write your own software to do using their API if you wanted to get complicated. But I don't want to get complicated. I just want something that looks for credit spreads that meet all of my criteria. So in the next video, I'm going to walk you through my own custom scanner, and I'll give you a link to a second video that shows you how to install it so you can run the scanner yourself. It's absolutely free if you have a TD Ameritrade account. So I think you're going to like it. I'll see you in the next video. If you want to see more videos in this series, make sure you click the like and subscribe buttons below.